Fast profits, real risks, the intraday trading game. The stock market. A whirlwind of numbers, charts, and split-second decisions. Fortunes made and lost in the blink of an eye. It's a world that both fascinates and intimidates, especially for those new to the game. But what if you could cut through the complexity and tap into a strategy that offers the potential for quick profits? Welcome to the world of intraday trading, where the name of the game is speed, and every trade starts and ends within a single trading session. Before you dive headfirst into this exciting but volatile arena, it's crucial to understand the basics. Intraday trading isn't a get-rich-quick scheme. It requires knowledge, discipline, and a healthy respect for risk. In this guide, we'll demystify the world of intraday trading, breaking down complex concepts into bite-sized pieces. We'll explore the essential terminology, walk you through the mechanics of a trading platform, and arm you with practical tips to navigate the markets with confidence. Remember, knowledge is power, especially in the fast-paced world of intraday trading. So, buckle up and get ready to embark on your journey to becoming a savvier, more informed trader. To continue watching videos like this, please subscribe to our TrendTalkTube YouTube channel. Profit from the daily grind. Intraday trading, also known as day trading, is all about capitalizing on short-term price fluctuations in the stock market. Unlike long-term investors who hold onto stocks for months or even years, intraday traders aim to buy low and sell high, all within the same trading day. They close out all their positions before the market closes, avoiding the overnight risk associated with holding stocks overnight. The beauty of intraday trading lies in its potential for quick profits. By leveraging market volatility and reacting swiftly to price movements, traders can potentially generate substantial returns in a short period. However, it's important to remember that with high reward comes high risk. Intraday trading is not for the faint of heart. It demands quick thinking, a sound understanding of market dynamics, and the ability to manage emotions effectively. Before you jump into the fray, it's crucial to educate yourself on the fundamentals of technical analysis, risk management, and trading psychology. By equipping yourself with the right knowledge and tools, you can increase your chances of success in the exciting but challenging world of intraday trading. Speaking the language, key terms for intraday success. Before you can master the art of intraday trading, you need to learn the language. Understanding key market terms is essential for making informed trading decisions. Let's break down some fundamental concepts. Open price, the price at which a stock begins trading at the start of the trading day. Close price, the final price of a stock at the end of the trading day. High, the highest price a stock reached during the trading day. Low, the lowest price a stock reached during the trading day. Volume, the total number of shares traded in a particular stock during a specific period. High volume often indicates strong interest in a stock, which can impact its price. Stop loss, a predetermined price at which you automatically sell a stock to limit potential losses. This is a crucial risk management tool for intraday traders. By familiarizing yourself with these terms, you'll be better equipped to understand market data, analyze price charts, and make informed trading decisions. Remember, knowledge is power, and in the world of intraday trading, every bit of information counts. Your trading dashboard, navigating the platform. Imagine a cockpit filled with screens displaying real-time data, charts, and order entry windows. That's essentially what a trading platform is for an intraday trader. It's your command center for navigating the markets and executing trades with speed and precision. While the specific features and layout may vary depending on the platform you choose, the underlying functionality remains relatively consistent. One of the first things you'll want to do is set up a watch list. This is a customized list of stocks that you're interested in monitoring. You can add or remove stocks from your watch list as needed, allowing you to focus on the securities that align with your trading strategy. Next, you'll need to familiarize yourself with stock charts. These visual representations of price action over time are essential for identifying trends, patterns, and potential trading opportunities. We'll delve deeper into chart analysis in the next section. Charts, candles, and patterns. Visualizing price action. Stock charts are the bread and butter of technical analysis, providing valuable insights into a stock's historical and current price movements. For intraday traders, understanding how to read and interpret charts is crucial for making informed trading decisions. One of the most common chart types is the candlestick chart. Each candlestick represents a specific time frame, such as 1 minute, 5 minutes, or 1 hour. The body of the candlestick represents the opening and closing prices for that time frame. A green candlestick indicates that the closing price was higher than the opening price, while a red candlestick indicates the opposite. The thin lines extending above and below the body are called wicks or shadows, and they represent the highest and lowest prices traded during that time frame. By analyzing the shapes and patterns formed by candlesticks, traders can identify potential trading opportunities based on support and resistance levels, trend reversals, and other technical indicators. Placing your bets, understanding order types and the order book. Once you've identified a potential trading opportunity based on your analysis, it's time to place an order. But before you do, it's crucial to understand the different order types available and how they work. The most common order types are market order. This type of order is executed immediately at the best available market price. It's the fastest way to enter or exit a trade, but doesn't guarantee a specific execution price. Limit order. With a limit order, you specify the price at which you're willing to buy or sell a stock. The order will only be executed if the market price reaches your specified limit. Stop order. Similar to a stop-loss order, a stop order is triggered when the stock price reaches a certain level. However, instead of selling to limit losses, a stop order is used to enter a trade when the price breaks above or below a certain point. Another important concept to grasp is the order book. This electronic list displays all the buy and sell orders for a particular stock at any given time. By understanding the order book, you can gain insights into the supply and demand dynamics of a stock and anticipate potential price movements. Risk and reward, protecting your capital. Intraday trading, while potentially lucrative, inherently involves a significant level of risk. Protecting your capital should be your top priority. Before entering any trade, it's crucial to have a clear understanding of your risk tolerance and to establish a risk management plan. One of the most effective risk management tools is the stop-loss order, which we discussed earlier. By setting a predetermined price at which you'll automatically exit a trade, you can limit your potential losses on a losing position. Another essential aspect of risk management is position sizing. This refers to the number of shares you buy or sell in a single trade. It's generally advisable to risk only a small percentage of your total capital on any given trade, typically no more than 1 to 2%. By keeping your position sizes small, you can mitigate the impact of losing trades and protect your overall portfolio. The learning curve practice makes profitable. Mastering the art of intraday trading takes time, dedication, and a willingness to learn from your mistakes. Don't expect to become a consistently profitable trader overnight. Like any skill, it requires practice, patience, and a commitment to continuous improvement. One of the best ways to hone your skills is to start with a demo account. Most online brokers offer simulated trading environments where you can practice trading with virtual money. This allows you to familiarize yourself with the platform, test different trading strategies, and gain experience without risking real capital. Another valuable learning tool is backtesting. This involves applying your trading strategy to historical data to see how it would have performed in the past. Backtesting can help you identify potential flaws in your approach and fine-tune your strategy for better results. Ready to trade? Start your journey today. Intraday trading can be an exciting and potentially rewarding endeavor, but it's not for everyone. It requires a unique combination of skills, discipline, and risk tolerance. If you're willing to put in the time and effort to learn the ropes and develop a sound trading strategy, intraday trading may be worth exploring. Remember, knowledge is power, and the more you learn about the markets, the better equipped you'll be to navigate them successfully. Start by researching different online brokers, comparing their fees, features, and educational resources. Consider opening a demo account to practice trading with virtual money before risking real capital. And most importantly, never stop learning. The world of finance is constantly evolving, so stay informed, adapt to changing market conditions, and never be afraid to seek guidance from experienced traders or financial advisors. Your journey to becoming a successful intraday trader starts today.